Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. This is a Forex educational video. I'm going to title it the 50% 200 bar moving average rule. So what is this rule? The trend for the dollar Swiss has been down in trading over the last day or so. However, when the price reached an area where the 200-hour moving average and the 50% retracement were at the same area, the selling suddenly stalled. In our chart, the 200-hour moving average came in at the 0.9667 level, and the 50% retracement came in at 0.9670. The low stalled at 0.9671, just above both those two levels. In general, when the 100 and 200 bar moving average are a good distance apart, like they are on the hourly chart today, and the 50% retracement of the most recent trend is near the 200 bar moving average, you can expect the level to stall the corrective move, at least on the first test. It is a good place to take profit or enter a trade looking for a bounce. I call it the 50% 200 bar moving average rule. Why does the price tend to stall against two levels? Let's break the trade down. When the 100 and 200 bar moving average are far apart, it says the recent trend has been pretty strong. In the dollar versus Swiss, the main trend on the hourly chart has been to the upside. Since it is a decent trend, the 100-hour moving average is going to move at a faster pace than the 200-hour moving average. This creates a distance between the two moving averages. One leads, one lags, but both are trending higher. Now, if you get a fairly quick correction in the opposite direction of the trend, the price typically stalls first at the 100-hour moving average. Why? Because the trend is respected. Traders will give the benefit of the doubt to the trend, and the 100-bar moving average is often a pretty good test as to the strength of the trend. Now, if the moving average holds, the bulls remain in control. If the 100-bar moving average is broken, like it was today, the correction is not over. One of the next major targets becomes the 200-hour moving average. Getting below the 100-hour moving average is one thing. The bias may not be as strong, but the trend is not necessarily over. Now, if the price were to head below the 200-hour moving average, it would tell me a different story. It would say to me that all the work to trend higher was for naught. The bias is now switched from being to the upside to being more bearish or to the downside. This is hard to do on the first test, especially after trending higher. In the example, it took 5 days of steady upside trending and about 1 day to unravel nearly 50% of what was done. Did the world change so dramatically to cause a shift? Maybe so, but oftentimes the market is not so quick to give up on the major trend. And as a result, traders will tend to lean against the 200-hour moving average to take profit and or get back on the trend at a lower level. Where is the stop? In our example, just below the moving average, maybe 10 pips or so of risk. Now, when you add the 50% retracement in the mix, it adds yet another reason, another dimension to stall the correction. The 50% is just as important as a 200-hour moving average in determining bullish and bearish. I look at the 50% retracement as the inflection point between bullish and bearish in a trend move. In an up move, if you stay above the 50% retracement, the bullish trend is still intact. If you go below the 50% retracement, it switches the bias around to bearish. The opposite is true on a downtrend. That is, if you stay below the 50%, the bias remains bearish. If you move above the 50%, the bias switches around to being more bullish. Like the 200-hour moving average, the 50% retracement represents a strong line in the sand between bullish above and bearish below, simply because it takes a lot to suddenly switch what was a trend the other way around in such a short period of time. So by combining the 50% retracement and with the 200-hour moving average, it gives traders a pretty solid place to take profit on a counter trend move and or get back on the trend. The risk is only about 10 or so pips against the level when you first put the trade on. If the market moves your way about 10 or 15 pips, move your stop back to break even. Does it guarantee that the trend is back on? No, but it does give the counter trend traders a cause for pause, and that might be enough to reignite the trend with little risk. If you would like to receive meaningful educational videos like this one sent directly to your inbox, simply go to the ForexLive website at ForexLive.com and click on the education link here. From there, fill in your name, email address, and where you are from, and we will make sure you continue to grow as a trader, as a profitable trader. My name is Michalowski for ForexLive.com. Good fortune with your trading. Bye-bye now.